Well, I think the Queensland economy has obviously registering quite strong growth numbers on the basis of the mining boom. But if I look at other parts of the economy around housing, consumer spending, retail sales, the labour market, it's nowhere near as healthy. Well, we think that economic growth will plateau a bit this year. If we look at, say, the mining story, we expect that the mining spending will peak sometime around the middle of 2013. And so the ongoing stimulus that mining's been giving the economy will start to fade a little. What we'd like to see is other parts of the economy, particularly around housing, property, consumer spending, start to fill in that gap. And at this stage anyway, the signs are not that encouraging, particularly in terms of new lending for housing has been quite soft. We haven't seen the first home buyers in the market at all, or the investors. It's really only been the upgraders, and they're not a big enough part of the housing market to get that part moving. In terms of overall business confidence, that's fairly patchy, and so the prospects of the key challenge for not only the Queensland economy but for the Australian economy is to stimulate that interest rate sensitive part of the economy to fill the gap that's being created by the slowdown in mining. And at this stage anyway, we're not having a whole lot of success. Now that's why we expect to see interest rates lower, and that's why we feel that eventually we will start to get some traction there, but the signs at this stage are uncertain. Look, I'm not sure about the actual extent of the damage in agriculture. I'm always worried about the fact that tourists tend to hear bad news, and therefore it slows new tourism down rather than necessarily affecting current existing opportunities. And I don't really know the answer to that. I don't think anyone does. But I'm sure the government is well and truly prepared to act quickly to direct help to these sectors. Well, the US economy, as you know, contracted in the fourth quarter of last year, and that was partly due to a big fall in government spending, and that's going to be a factor over the next few years. The labour market remains fairly uninspiring. Housing has stopped taking away from growth, but it's now such a small part of the economy that it's unlikely to really do the trick. My view is that the consumer will remain nervous. We saw a big fall in consumer sentiment yesterday, so I'm still quite concerned about the US economy, and I think that over the next few years, how they're dealing with very high sovereign debt is going to ensure a fairly lacklustre growth in the US. Well, I certainly hope so. Bear in mind that at this stage of previous easing cycles, we've seen house prices up by between 10 and 20%. And at this stage anyway, in this cycle, house prices have struggled just to offset the losses that they made in the first few months of that cycle. So I would expect for that reason and for the fact that we're not seeing the first home buyers coming into the market, I would expect that the house price appreciation this year might be around 5%, but nothing like the sort of appreciation you would normally expect given how low we've seen interest rates.